Section 5:1 Introduction to Modern Portfolio Theory, Risk Management and Portfolio Optimization. 5.1 Risk Management Techniques. Risk management techniques are essential for effectively managing investment portfolios and mitigating potential risks. Here are 3 key risk management techniques commonly employed. Diversification. Diversification is a risk management technique that involves spreading investments across different asset classes, sectors, regions, and securities within a portfolio. By diversifying, investors aim to reduce the impact of any individual investment's performance on the overall portfolio. Diversification helps lower the portfolio's exposure to unsystematic risk, also known as specific risk or idiosyncratic risk, that is unique to individual assets or sectors. It allows for potential losses in some investments to be offset by gains in others, potentially smoothing overall portfolio returns. Diversification does not eliminate all investment risk, as systematic risk, related to the overall market or economy, still affects diversified portfolios. Asset allocation. Asset allocation is the strategic allocation of investments across different asset classes, such as stocks, bonds, cash, real estate, and alternative investments. By determining the appropriate allocation percentages to each asset class, investors can balance risk and return based on their investment goals and risk tolerance. Asset allocation aims to achieve diversification at a broader level and ensures that the portfolio is aligned with the investor's long-term objectives. A well-constructed asset allocation can help manage risk by reducing the concentration of investments in a single asset class and by taking advantage of different asset classes' risk-return characteristics. Rebalancing. Rebalancing involves periodically adjusting the asset allocation of a portfolio back to its original or target allocation. Over time, asset classes may experience different performance, resulting in a deviation from the desired allocation. Rebalancing allows investors to restore the desired asset class weights and maintain the risk profile of the portfolio. It typically involves selling assets that have outperformed and buying assets that have underperformed, effectively selling high and buying low. Rebalancing helps investors avoid becoming overexposed to assets that have performed well recently but may be overvalued and vice versa, ensuring that the portfolio remains aligned with the investor's long-term objectives and risk tolerance. These risk management techniques work together to help investors effectively manage risk in their portfolios. Diversification reduces the impact of individual investment risks. Asset allocation sets the strategic framework for risk and return trade-offs, and rebalancing maintains the desired asset allocation over time. By employing these techniques, investors aim to reduce the potential downside risk while optimizing the potential for returns. It's important to note that risk management does not guarantee the elimination of investment losses, but it can help manage risk exposure and improve the potential risk-adjusted returns of a portfolio. Implementing risk management strategies to control downside risk involves a proactive approach to protect investment portfolios from significant losses during unfavorable market conditions. Here are several strategies that can be employed. Stop-loss orders. Stop-loss orders are instructions given to a broker to sell a security if it reaches a predetermined price level. They act as an automatic trigger to sell a security when its price falls below a specified threshold. Stop-loss orders help limit potential losses by ensuring that positions are exited if the market moves against the investor's expectations. Hedging. Hedging involves taking positions in securities or derivatives that are negatively correlated to the assets held in the portfolio. For example, purchasing put options can provide downside protection for a specific stock or index, as the put option gains value when the underlying asset's price declines. Hedging strategies can help offset losses in the portfolio by providing a potential source of profit during market downturns. Asset class diversification. Diversifying the portfolio across different asset classes, such as stocks, bonds, cash, and alternative investments, can help reduce the impact of market volatility. Each asset class has its own risk-return characteristics. And when combined in a diversified portfolio, they can potentially offset losses in one asset class with gains in another. By diversifying across non-correlated or negatively correlated assets, investors can reduce their exposure to specific market risks. Risk-adjusted position sizing. Implementing risk-adjusted position sizing involves allocating capital to different investments based on their risk levels. This strategy involves considering the potential downside risk of each investment and adjusting the position size accordingly. Investments with higher downside risk may warrant a smaller allocation, while investments with lower downside risk may receive a larger allocation. By managing position sizes relative to risk, investors can control the impact of any single investment on the overall portfolio. Regular portfolio monitoring and rebalancing. Ongoing portfolio monitoring is essential for identifying potential downside risks. By regularly reviewing the portfolio's performance, market conditions, and economic indicators, investors can assess whether adjustments are needed. Rebalancing the portfolio periodically helps maintain the desired asset allocation and ensures that the portfolio's risk exposure remains in line with the investor's objectives. Active risk management. Active risk management involves actively monitoring and adjusting the portfolio's exposure to different asset classes, sectors, or individual investments based on changing market conditions. It requires continuously assessing the portfolio's risk profile, considering market trends, and making informed decisions to protect against potential downside risks. Active risk management strategies can involve employing tactical asset allocation, dynamic hedging, or other active investment techniques. It's important to note that risk management strategies do not guarantee the complete elimination of losses, and there are costs and limitations associated with each strategy. Investors should carefully evaluate the suitability of these strategies based on their risk tolerance, investment goals, and the specific market environment. Working with a financial advisor or investment professional can provide valuable guidance in implementing effective risk management strategies tailored to individual circumstances.